Marco did announce that he was going to be talking at 4 o'clock, giving us an educational session. So Marco Vitrò, owner of International School of Trading. And Marco, please come and educate us. Thank you.
Well, we are in Dubai. You're seated. You listen to me. I'm sure I will tell you something very interesting. Let me introduce myself to you. My name is Marco Vitrò. I am 65 years old. I'm the owner and the chief teacher of this International School of Trading. The words you can read are the motto of the school, of the International School of Trading. There are no expert traders or beginner traders on Forex, but only traders who lose and traders who win, or better say, who gain. I don't like the word win. Jesus, let me go back. Okay. Why I say this? Because experience is not synonymous of ability. Because experience in human matters is nothing, just for this reason, that is not synonymous of ability. And I can say this because the unit of measurement of the experience is a time. When somebody does a work since maybe 15 years, everybody thinks, and he is a spirit, but he is the same person, also has competence, ability? No, of course not. Because ability, competence, as a unit of measurement, the results, and not from how long time you're doing that kind of work, your workout. And I'm here today just to speak to you about what must be the results and not what could be the results in a trading operations. How the market moves. Somebody thinks that behind market there is an occult mind who moves everything. A sort of financial director who decides everything on the markets. This is not my opinion. I think that market has a random trend. It means that everybody does what everybody does. Everybody sells when everybody sells, or buy when everybody buys. Because nobody can take the risk to go contrary to the rest of the financial world. This is my opinion. And consequently, what is the main problem, the real problem of every trader is the impossibility to know in advance the trend of the instrument, the financial instrument on which he intends to work. Because nobody can know the future. This is the main problem of a trader. How will move my instrument on which I want to trade? Somebody thinks that he can solve this problem. This problem is not possible to be solved, but somebody thinks can be solved by technical analysis. No way. Technical analysis, they propose to us as a chance, but it's not a chance. Because to be a chance means for a scientific test. A scientific test means that can be replicated by everybody in different times. But in technical analysis, what could be good for me it doesn't mean will be good for you tomorrow. You see, Gann, Elliott, Fibonacci, head and shoulder are all good ideas, nothing proved at the moment. All the ideas. We can say that Gann, Elliott, was two dreamers, traders, lived it too long time ago in different financial conditions from now. And Fibonacci was sure a great mathematic, but to hope, to think, to apply his mathematical theories on trading strategies means always endeavor to lose money. No way. What I want to tell you today, what I want to show you, will be a simple way to make trading. A trading method, strategies, which is called spread trading, convergent spread trading. And what is this spread trading? First, we should say, and we can declare, strongly declare, again, that the only problem of each trader, so the risk is that we cannot know the future trend of the instruments on which we intend to work. That is the definition of the risk. Risk is only that. The fact that we can't know if the trend will be rising or fall down. On this, everybody agrees. That is the risk. And let's see how we can overcome this risk. I told you that I'm going to speak about the spread trading. Spread trading is theoretically simple strategies based on correlation of instruments. Correlation means that two instruments has always and ever the same trend, whatever can happen on the market. So when we speak about correlation of two financial instruments, we say that these instruments has always the same trend. This is the base of the spread trading. How can it help us? Well, let's see. Many and many are the financial instruments which are correlated. Of course, everybody prefers to use some of them. For example, my preference goes on Australian dollar, New Zealand dollar, because Australia and New Zealand are inside the British Commonwealth, because they are geographically near, and because the economy are almost similar. Now, what I'm showing you now, what you see is overlapped chart of Australian dollar, United States dollars versus New Zealand dollars, United States dollars. As everybody can see, They are very well correlated. I repeat, correlated means they have always the same trend. Not equal trend, just the same trend. We can say the trend is always the same. Of course, there are some differences. And this is what we like. The difference between two instruments who has the same trend. Why we like? Because this difference are the origin, will be the origin of our profit, as I will show within few minutes. These are two of the instruments on which I like, I suggest to work with spread trading. Also, we can see the Australian dollar with the Japan yen versus New Zealand dollar with yen. Same chart, same correlation, same trend. Little bit difference. Those differences will build our profits, as I will show you within a few minutes. This is what I want you to look and put in your mind. The same time they're moving. We could work also in some other instruments. I repeat, many instruments are well correlated. Those instruments are those which I prefer. I prefer these two. I showed you, and we can work on stocks index. Example, European stock index. Shown here are CAC 40 is an index, France index, versus euro-dollar, I used 50 index, is European index, very important index. As you can see, they have always the same trend, very high correlation. Some other we can use for making our spread trading are other index, the American index. Here we show the NASDAQ use a technology, and Standard & Poor's 500 use 500 index. As you can see, also these are very well correlated. I am insisting very much on the correlation, showing you, because this is the heart of this kind of trading strategy. We could work also on two commodities. Many commodities are well correlated, but I prefer these two. Petroleum commodities. We see here Brent crude oil and light crude oil. See? Same trend, always and ever. When I say always and ever, means that there was always and there will be ever correlated. Because we are using this kind of strategies just to close the door to the risk. And the only risk we could meet using this kind of method is that if they lose the correlation. Only this is the point, risking point. That's why I am indicating some of my preferred instruments. Now, I showed you some real charts. Let's work with Imagine. I will make you a sample, which seems to be a stupid sample, Yes, it is a stupid sample, but please let me do it because it helped me to carry on your attention, your understanding, what I want to say, what I want to explain to you. Let's imagine in the morning to sell and buy at the same time, same quantity in money of gold. And coming back in the evening and closing our position. As everybody knows, for closing position, we must do exactly the contrary of what we have done for opening position. And of course, when we are going to close this position, the result, the balance, will be equal to 0 because we sold and bought gold at the same time. Of course, this is just a stupid sample, as I said, without considering the cost of the operation, naturally. But what could happen if instead selling gold or buying gold and selling gold, I could buy gold and sell silver? Gold and silver are other two very good correlated instruments. And now I want to show you a drawing. It is a drawing, of course, but it helped me to explain you what I want to tell. This is the drawing. This is the drawing. Now, imagine we're showing just the drawing, the correlation of the two instruments, gold and silver. And we imagine to give of such periods, crossing periods, the value in time of 1 hour. Okay? And we imagine to sell here silver and buy gold. And at the first step, after 1.5 hours, to close the position. For closing this position, we should buy silver, burdens of what we sold. We will generate loss. We could sell gold, little bit better of how much the price we bought, generating a little profit. The difference, the balance between two, of course, will be a loss for us. But if we wait another hour, and we go to the second end, the position will change, the situation will change, completely change, because we could sell gold much better what we bought, generating a good profit. And we must buy silver burdens of what we sold, generating a loss, but the balance will be profits. What means this example? Means that when we have two correlated instruments, will become only a matter of time, because we will always have one position which will be prevalent of the other position. Will be the time on which the losing position will be prevalent on the profit position, and then will change, the profit position will be prevalent on the losing position. Before or later, sooner or later, will change their position. And when we'll see that our balance will be positive, just close at the same time both positions and bring at home the profit we got. Just wait, because they are correlated. They work together. Down and up, they will always have the same trend. They run one behind the other one. Very easy, very simple. Of course, easy and simple is the theories, but to apply is a little bit more difficult on the real market. But I'm not here to explain step by step what you could or you should do to learn this kind of the technique. Well, some other thing I want to tell you. This is called Spread Trading Convergent. Why? We must know always, in every kind of trading we do, what we should know is when to open, when to enter in a position, when to close, how to open. Let's see when. The name is Spread Trading Convergent. Because if we could see, if you could understand the points of a good divergence, not convergence, divergence. For example, I go near here. This is a big divergence. They are apart each other. If we could understand, see, graphically or with other method, which I could teach you, these points, we could know what to do. Because we are going to sell silver at this point, we're going to buy gold at this point, and when they will converge, we'll take profit with both of them. That's why it's called Spread Trading Convergent. So entering when we can understand, when we see, we have the hypothetical best divergence of the two instruments. Then we know what to do. And what to do, how to do, we can say, in case of rising trend, I will sell the instrument is rising more, and I will buy the instrument is rising less. Of course, in case of falling trend, I will buy the instruments for more, I will sell the instruments for less. In this case, the trend, rising trend, I sell who rise more, I buy who rise less. Continues their trend, they will converge. And they will converge. Sooner or later, they will converge. I show you back. I will show you again what I showed you before. Maybe you're not following me. You see? Sooner or later, first red one up, then black, then red again, then black again. We don't call the name, okay? But just see the colors. It's just a matter of time. You don't need. You have no more the problem. So, consequently, if we have not to worry about which will be the trend, because in any trend, in any case, we always will have one position we lose and another position we take gain. Always. Everything can happen in the world. Trump decide to bomb China? No problem. Market will fall down? No problem. I will have one position losing, one position taking profit. So, consequently, if I have not the problem of the trend, to know in advance which trend I'm going to meet, And as we said before, that the risk consists only in the impossibility to know in advance the trend on which we are going to work, or equally means that this strategy is a risk of zero. Risk, zero risk. This is the only strategies universally known as strategies by zero risk. Of course, you must know how to do it. It is the theory. Theory is very simple. Practical, apply on the real market, a little bit more difficult. But just I wanted you to explain that it's possible to trade without risk. Now, I hope everybody understood what I said. Yes, that is what I hope. That I'm sure it happened. And if anybody wants to know more about, yeah, tell me. Excuse me, if you come here, you can use.
Is it working? Yes. So we just have a couple of questions and then we'll close off for the coffee break, yeah? Is that okay?
If anybody has a question, I'm here to answer.
Yeah, as in, have you finished the session? Sorry. Have you finished your session?
No, I didn't
You're
finish.
still going?
No.
Oh, okay, so then maybe make it really quick. Okay.
Okay, my question is, in case of uptrend side, when the trend is up for both of the correlations pair, so which one we buy and which one we sell? So you mentioned it, but I
No,
didn't
when,
know. Yeah.
any two correlated instruments, they always run together in the same trend.
Right.
What we must wait, patiently wait, that they show a bit divergence.
Okay.
Then, looking the divergence, we know what to do. And what we will do, I repeat, we will sell in case of rising trend.
Yeah.
We will sell the one when rise more, and we buy the one who rise less. And just wait. When they meet,
Sell the upper one, buy the lower one
yeah,
on the uptrend.
yes. And when they go down, buy the lower,
lower.
sell the other correlated.
Thank you very
And
much.
then patiently wait. Okay. Don't watch the
Continues.
monitor. Never watch the chart. This is normal for people who stay hours and hours to watch the charts. No way to make trend.
Thank you very
Trading.
much.
Sorry, and we close the position when the two instruments change the...
No. We close the position when we reach the profit we want. Normally, the profit we are waiting is about 1% of our capital, real capital we're using. This is another argument.
Okay,
When
guys,
close.
I just want to say that, by the way, because the coffee break is only 10-15 minutes, I will leave
1,
it
2,
with you.
3, I finished. Okay? Which are also complicated to be carried on. Thank you.